Retail traders frequently become exit liquidity because they react to the news, buying when headlines are loudest. Institutions, the FIIs and DIIs, do the exact opposite. They track hard data and they build their positions in silence. Before we start, this is for educational and research purposes only. We are not SEBI-registered advisors, and these prompts do not constitute financial advice. You are solely responsible for your own trades. Adopting a strict data-first workflow is the absolute baseline requirement if you want to preserve your wealth in the Indian stock market. Professional desks already have their levels mapped out before the bell rings. This formatted text block is your first prompt. It configures the AI to act as an institutional derivatives desk. You are instructing it to analyze the latest Nifty and Bank Nifty option chain data, incorporate the current India VIX, and track the latest FII and DII net flows. Once the data is in, we demand 3 specific outputs. We need the most probable intraday trading range, an opening hour directional bias, whether bullish, bearish, or sideways, and the key levels where momentum will actually accelerate. Once the index is mapped, we move to individual stocks. The goal here is to stop asking what to buy today and instead find where institutions are quietly accumulating shares before a visible breakout happens. Look at the second prompt. Here, we command the AI to act as a quantitative screener. It searches the NSE for volatility contraction patterns, or stocks where delivery volume is twice the 10-day average. We strict filter for a market cap over 5,000 crore rupees, price above the 50-day EMA, and zero promoter pledging. For every stock that passes the filter, the AI must provide the immediate resistance level that acts as the breakout trigger, the specific volume confirmation signals required, and the downside risk if the setup fails. Combining this pre-market index mapping with automated accumulation screening allows you to spot institutional positioning early, rather than reacting late when the retail crowd finally notices. Now we need a defense mechanism. Every day, social media pushes multi-bagger recommendations. By the time a stock is trending online, the smart money that bought early is often looking to sell to you. This text block is prompt 3. It forces your AI to act as a strict, emotionless risk manager. When you plug a trending stock tip into that red bracket, the AI cross-checks its trailing PE against the 5-year median, evaluates the daily RSI, and scrutinizes the delivery percentage trend over the last 5 sessions. Based on those hard metrics, the AI strips away the hype and issues one clear verdict: avoid, wait, or consider with caution. Next, we have to look past standard price charts. In F&O trading, price action is easily manipulated to trigger your stop losses, but the sheer capital deployed by option writers cannot be hidden. It defines the true boundaries of the market. This brings us to our fourth prompt. We direct the AI to analyze the near-month option chain for your specific stock or index. It scans specifically for the strike prices experiencing the highest fresh call and put writing. From that open interest data, the AI calculates the max pain level, establishes the most probable range for expiry, and maps out the path of least resistance. Using the AI to independently verify hype and decode the option chain protects you from falling into late-stage momentum traps. There is one final safety check. Professional traders understand the macro veto. You can have a flawless technical setup on an Indian stock, but if the global markets suddenly drop, your local trade will likely fail with them. This 5th text block is your macro shield. Before initiating any position, you require the AI to analyze the overnight U.S. market performance, the current trend in Brent crude oil, and the USD to INR movement. We also instruct it to scan for major geopolitical developments, key macroeconomic data releases, and upcoming announcements from the RBI or the Federal Reserve. The AI digests these variables and delivers a definitive judgment on the overall global sentiment, telling you whether a bullish local trade is actually supported. The global macro environment dictates the flow of capital. If you ignore it, you expose even your best researched local trades to unpredictable systemic risks. Let's summarize the 3 rules of the institutional playbook. Rule 1. Data kills the drama. Always verify the headlines with raw numbers before risking a single rupee. Rule 2. Follow the liquidity. While the crowd watches the current price, you must track where the heavy capital is actually positioned. And Rule 3, as shown in this model, respect the macro veto. If the global environment is hostile, prioritize your defense. These three pillars, data, liquidity, and macro, support the ultimate goal of preserving your capital. Trading is a systematic process of risk management. It requires steady, deliberate execution over years, rather than chasing quick profits on a random Tuesday. Put these 5 AI prompts to work. Stick to the rules, step away from the noise, and start approaching your portfolio with the discipline of an institution. Trade safely.